The last 12 months, there'd been 12 expired listings in the complex and 9 sold. So he's like, you're more likely to expire and not sell. That kind of informed his strategy. They did get this one sold. That's just continuing to be the market that we're in, right? Of like, you don't see this crash because you really don't have a super motivated seller typically. Most people are willing to hold on to these. They're not upside down. They're not in financial distress. They'll hold out for a better time to sell it.
What's up, Colorado? Chris Lopez here, the host of the Denver Real Estate Investing Podcast, and we're going to be talking about the July market trends for Denver Metro. So we are going to talk about trends, news articles, plus the first thing I've ever seen, a $1 condo for sale in Lakewood. We'll also talk interest rates, and I'm joined by half the panel today. You know, we're in the final throes of summer, so people are traveling, but I've got Brandon with Key Renter and Troy with Nova Home Loans. What's up, gentlemen?
What's up?
Yeah,
good to be back.
We made it.
Yes, I'm glad only half of us are on vacation this week, so thank you guys. But we got some fun stuff to talk about today as usual. But I think let's start with the trends and then move on to what Brandon pointed out from a friend of his who texted him about a $1 condo listing. But we'll talk trends, then jump into that. So looking at the trends here is the high level of what we're looking at. So from active inventory, this is, I always think, the best gauge to look at. Active inventory, I mean, we are up so marginally. We're down so marginally from June. So we were at 13,995 active inventory at the end of July. End of June was 14,007. So what's that? A 12
listings.
12 listing difference there.
You can say it's just flat.
Yeah.
That number.
Well, it's like so close on there.
Yeah.
So month over month, we were basically flat, like down negative 0.09%. But when we get to historical, active listings typically increase 5.6% from June to July. So that was the interesting thing, but I wanted to get very nuanced on there for the numbers on there. So that very small decrease suggests that the seasonal peak of inventory is behind us. And then the other thing, we're about to say something?
No.
Sorry.
No.
And then the other thing is looking at pricing on here. So let's dive into pricing. So year over year, we're down about 1% when we look at the total market on there. So negative 1% average, negative 1.7% median. And of course, coming down here to detached versus attached, I think just kind of continues the story of what we're talking about on here. Detached is down about negative 1% on price year over year, where attached is down almost negative 7%. Now let's pause here because I think this perfectly goes into Brandon, what your friend was sharing us. What do you do with his condo this past weekend?
Yeah, so he was in the kind of typical condo seller right now. This is in the like mid 200s, a 2-bed, 1-bath, I think. And he's lowered it. I think he's gone from 250 or 260 started down to like 240, and finally just was like, I gotta see what I can do to get some interest here, so lowered it to $1. So he had heard this somewhere with the idea that the list price is simply a negotiating starting point.
Yeah.
So
put it on the screen to prove it, right, Chris?
Yeah, well, also, hey, if he's doing, let's give him some free publicity, right?
Yeah,
let's help him sell this.
Somebody go look at his condo.
Yeah.
See how low he's willing to go.
Yeah, so it's in Lakewood, 2-bed, 1-bath condo, 950 square feet. And I've got the Zestimate pulled up here, or Zillow. So Zillow estimates it's $220,000. 100 days on market and dropped it to $1. What you said just a few days ago, right?
Yeah, I think this was just Thursday or Friday or something.
Yeah, so we're recording on Monday, so it's been 3 or 4 days.
So we had the weekend, and he said they had a showing, and they had an open house. Nobody showed up for that.
So 0 at the open house.
Yeah. So.
Wow.
That is bad. So, and you said they've gotten some just silly offers in, right?
Yeah.
Well, I'm
He
curious.
didn't tell me how much, but
Yeah.
he said they got some joke offers, but I'm like, aren't you the one starting the joke here?
Yeah, I mean, if
what do you
you're
expect?
if you're putting in $1, I mean, I I mean, if you're out there actively doing deals, you have to put an offer on something that's $1. I feel like.
Yeah.
But it goes to show, just like I want to bring this up. So we were talking about the data on, overall. Then you really have to look at like condos versus detached properties. Like they're just so different and they're diverging on there. Where I mean, things like this where condos just simply aren't moving.
Yeah.
And then you have to do $1 just to get some eyeballs and some traction on there.
It's crazy.
I heard another agent in like his newsletter just said he got a listing for a condo, and he was looking. The last 12 months, there'd been 12 expired listings in the complex and 9 sold. So he's like, you're more likely to expire and not sell than sell. So that kind of informed his strategy, and they did get this one sold. But yeah, that's just kind of an interesting. Yeah, it's just continuing to be the market that we're in, right? Of like, we don't see this crash because you really don't have a super motivated seller typically. Most people are willing to hold on to these. They're not upside down. They're not in financial distress. So yeah, they'll hold out for a better time to sell it.
Yeah, I'm curious though. Like when does the condo market just finally find its floor?
Yeah.
I mean the detached housing has been pretty stable. I think that will be slightly negative on the year, but we're talking like maybe a couple points. But condos, man.
I wonder if I'd be curious if you could somehow get the data on how many condo owners are starting to be delinquent, because I think that becomes like a huge problem for these HOAs, right? Because all their expenses are up, they're trying to raise dues, and yeah, that kind of kills the investment side of these things. So yeah, at what point does that start to snowball a little bit, where you have some people in default on their dues, and so you have a even further underfunded HOA that can't keep up with its bills? And
well, we've got the HOA side of it where expenses go up, and Troy, I mean, we talked about this, but what's the latest on just a lot of condos because they're underfunded, because of insurance, because of poor HOA?
Yeah.
Like a lot of them can't get agency financing, right?
Oh yeah, when you're talking Fannie Mae and Freddie Mac, that's where it really becomes a rub. And then of course FHA. I mean, I think these condo complexes, we've said time and time again, have completely dropped the ball.
And FHA is an additional step and harder than Fannie and Freddie, right?
Yeah, a little
so
bit
kind
more
of
of a
walk
hoop
us
to jump
through what it takes for a condo complex to get like, what conventional Fannie or Freddie, and then what it takes for an FHA, and anything like just commentary or stats.
Yeah, just from a high level standpoint, it's a little more of a hoop to jump through to get FHA approval for your condo complex. And I think the management companies have not done their ownership group a just cause by making themselves FHA eligible. And I'm sure there's a little the criteria. I don't have all the details on the criteria. When you're talking Fannie Mae and Freddie Mac, there's definitely how much ownership concentration is there? What's the owner occupied versus
sometimes you can't
investor?
just fix these things,
right? They're hard to fix.
Because what is it? It needs to be something like 60% owner occupied or something.
Not always. If you're buying as an owner occupant, it can be lower because Fannie Mae and Freddie Mac are trying to encourage ownership in those, and there's definitely some saturation, definitely at the lower price point condos. There's a lot of investors that'll go in and buy up those 200 when they were 100 back in the day, kind of thing. But yeah, and it's a moving target too, because a condo complex can be eligible, and then you go back to reevaluate it, and they can be knocked out from being eligible. And sometimes it's rare, but there's times when there's an insurance claim, especially if it's based on the builder. If somebody slipped and fell and they're suing the HOA for that, that's not going to prohibit it from getting Fannie Mae, Freddie Mac financing. But if there's structural issues or builder issues that they're suing the builder for something, then that's going to knock it out. So it's what we call in the world of lending is warrantable versus non-warrantable, right? So warrantable is a condo complex where we can do finance. Fannie and Freddie will be fine with. And there's a lot of banks that will do non-warrantables, and we're getting a lot of condo tail stuff, especially when you get up into the mountains, which can and cannot be potentially eligible.
So that means part of it's like rented as a hotel, and then part of it's condos. Or something?
Yeah, I mean, if it's condo tel, then that becomes hard for Fannie Mae and Freddie Mac to
is that what it is? Though I've never heard condo
because
tel.
It's kind of like short term. If there's a front desk, because they look at more from it's more commercial.
Oh, okay.
Type property.
So you're probably gonna have higher HOA because it has to support that kind of like guest check in and out and maintenance.
Yeah, but for us down in town, it's more about does the HOA have sufficient reserves? What's the concentration of investors in there? those types of things. And then the biggest one, and we've brought it up a few times, is the insurance coverage. Is the insurance adequate? Because Fannie Mae and Freddie Mac want to look at that, make sure there's adequate insurance. And they're a lower bar than FHA. You know, if a condo complex is FHA approved, I think it'd be interesting to see, but I bet you those complexes do better because they have more available buyers for those.
So on some of these complexes, I would think that you'd have like a price floor on, like, at some point if someone could, like in these complexes where it's primarily non-owner occupants. Mm-hmm. But if these people could go out and get like a CHFA loan and end up paying less than they're paying in rent to own it.
Yeah.
But is that a problem with, like, can you do CHFA on a deal that's non-warrantable?
No.
Or is that going to be paired with FHA?
Because at their core, they're basically the essential agency programs, and they're just kind of an enhancement on top of that for the assistance.
Okay.
And they become more expensive. And it's harder to qualify for the condos because then you got to account for that HOA.
Right.
So you got somebody with a $600 HOA, and that cuts into your allowable monthly payment dramatically.
What's
for
the
your
rule
debt
of
to
thumb
income
where if you
ratio.
have a $600 HOA, like how much is that like in an increased or decreased buying power compared to like a detached?
Oh, geez. Every $30, or you could say every $300 in HOA is $50,000.
Okay. So that's a rough, like just back in that
real
math.
rough, yeah. Some $325 HOA probably cuts your buying power by about $50,000, rough math. Yeah, so you can buy for the same payment a $50,000 more expensive house with no HOA.
I'd be curious out there. I mean, everyone I talk to, I think you guys too, is they're kind of trying to sell a condo. Mm-hmm. If anyone out there who's a listener is actually out there buying condos right now, let us know what type of deals you're seeing, what the play is there.
I'd love to hear that.
I haven't heard anyone talk about that. Like I know, people doing, buy plays for houses, buy plays for townhomes, buy plays for, apartments and multifamily. But I know no one out there doing buy plays for condos right now. So it's all just either hold or a 4-letter word and just trying to sell it.
Yeah.
What's the rental market like on condos, Brandon?
I mean, it's not great. Yeah.
Okay.
It depends what we're talking about here. If they're new construction, kind of townhome style,
or kind of Class A-ish.
Yeah, like those are great.
B+.
And then even on the other end, I think you have some kind of lower end stuff that seems to have sort of a price floor in the real affordability, like affordable range. But yeah, a lot of these, it's tough. We're down a couple $100 from where we were. I think there's just a trickle down too from, again, that new apartment inventory, right? When that's the alternative, is go get 6 weeks free and a bunch of perks for a Class A apartment. It kind of
especially for a brand new one.
Down. Yeah,
I mean,
that's where I would go.
Be the first renter in a brand new complex where you got some free rent.
When you're trying to compete with that and it smells a little funny in the hallway, kind of needs new carpet, that's tough, right?
That's super
Well, I mean,
tough.
I remember, after the 2008 great financial crisis, I was living in, I think, Florida at the time. And back then, it was, they built a bunch of these like condo complexes, and they all came to market in 2008, 2009, and just completely foreclosed on. And I mean, the place I moved into is like a $220 million building, and then some group bought it for like $20 million. So they bought it for like 10 cents on the dollar.
Wow.
And then I was like one of the first 10 people move into it as a rental, and I got this like amazing penthouse for dirt cheap. And of course I was like, in my 20s, like, yeah, let's do this.
Right.
It was great. It was fun. And it was a great deal for me, but
Was it like the pool never got finished and some
no,
of that?
It was completely finished.
Okay.
It was complete. And actually there were a few owners. I remember this. There were a few owners in the building who bought the condos. And I think in like the when they were pre-selling them, and they were, of course they're upside down. And of course they weren't happy with it being turned apartment now, and all these, tenants like me, they're running around, just being,
That's not what they'd envisioned.
Yeah, I was on more my party scene then too, just hanging out and drinking a little bit more and having fun. It was a fun time, but like same thing. Like I was like, this is a no-brainer. Like, let's go live in like a penthouse, and it was a blast. I mean, it was also like dirt cheap.
Yeah.
All right, so here's a really interesting trend on here. So this is back on the DMAR report here. So this green line is active listings, so total inventory, and then the orange yellow line down here is closed sales. So this is, I think, one of my favorite charts on here. So back here on the left, this is going from January 2008. Now we're July 25 data. So on the green here, we are right around that 14,000 mark for where we're at. And if you were to go back, the last time we had $14,000 house inventory was in right around 2012 timeframe, I think. And for those who can't see this chart, this is when really, inventory was just crashing, where it was just, this was a cliff going from 18,000 to about 10,000, from 11 to 12 back there. So that was, it was dropping on there. But our inventory is back to where we were, for a little bit in 2012, maybe end of 2011. The other interesting thing to look at is this orange line here is the closed sales, right? How many properties closed in this month? And you can see, the last 3 years since interest rates started going up, we have been, well below the average. We've been right around, anywhere from about 2 to 4,500 properties sold, kind of as we go through the seasonality trends on there. But, if you look at during the COVID era, hey, we were in the, 6,000-7,000 properties sold. And then from, right around 12 or 13 to 19 when the market was, hot, but not crazy hot. We were bouncing around from like 3,000 to 6,000 was that range. But back in the crash era of 2008, 9, 10, we were from 2,000 to 4,000. So our closed volume now is about the same as it was during the GFC.
Chart. Yeah, I like that chart too.
Yeah, so it gives really good perspective on here.
It's interesting too that like the population has grown since then too.
Well,
so relative to population, it's fewer transactions than.
And I remember that's one of the things when a lot of my great mentors over the years are like, hey, we on average we close, I think it was around 60,000 properties a year, give or take some on there. Kind of like no matter what, kind of historic, and when we've been well below the average. And you look at, okay, we've got way bigger population than 15 or almost 20 years ago now. But then a lot less transactions. It's just more pent up demand.
Yeah.
Mm-hmm.
And then here was another.
Is there anything that brings demand back other than lower interest rates right now that you guys foresee?
Lower prices? I don't really know. At some point, like the demand builds up or people, I would think, have to start looking or they move out but I think that comes down to more rates and economic stuff.
Yeah, I've seen some stuff on family formations, and we still have that population growth piece that comes into play. So hopefully that'll help along with some rates. There's
maybe programs to help first-time home buyers, that kind of thing, or to help unwarrantable condos or something. Like maybe these kinds of things would help with volume
for sure,
a little bit.
I think.
But are they coming? I don't know.
Yeah, that's the hard tell.
Well, part of you talk about first-time home buyers. Part of the problem is we don't have the first-time home buyer inventory, right?
Affordability.
Yeah, for just even the last
we got the condos
10 or 15 years.
If that's what they want to buy.
The ongoing HOA costs, and it's not just that.
Like it's no longer than an easy buy for a first-time buyer unless the price is like significantly lower than it is today.
And everything they've been building, it's always been like bigger properties and the more like affluent luxury side because there's like building costs and everything.
Well, it's more margin for the builder, right? The builders like those because they make more on those.
Yeah, they're building $700,000.
Though you've had
homes.
all the restrictions on the multifamily stuff where it has to meet certain, but that's not for buyers, right? But it has to meet like. Is there any of that on the build side where it's like in order to get your permit approved to build this thing that you're gonna like these condos or townhomes or something, it has to match like median income for the area or something?
There's different programs. I know Denver County, I think in 22 or 20, I think it was 2022, maybe 23, they went into effect an affordability, some type of affordability thing, and that impacts everything from people doing small projects to big projects, to where I can talk on a few deals where one deal I've invested in there, they're in Wash Park, so definitely not affordability, but they're building a 60 or 80 unit apartment building there, and it's usually around like 8 to 10% units have to be affordable, and it's based on some type of like
it's like
AMI.
30 to 40% of average or median income or something.
I forget the threshold; it's on the website, but it's like 8 to 10%, and then developers have two options: they can pay like a one-time payment. And that way they don't have to keep those properties at the reduced rent, or that roughly 8% of properties, they're kind of like grandfathered in or deeded into like longer term, lower rents based off of there. And then even one of our friends, Paul, he and his wife are doing, I think it's Sunnyside or maybe Berkeley neighborhood. They've been working on this project for a while, and they're adding square footage, and they had to pay around $20,000 or $22,000 in affordability fee.
Oh, wow.
And that kind of caught them off guard. I thought it was all for bigger projects, but it was any square footage adding on there. And of course, that was
affordability
a surprise. It's something like that. Like I'm not getting the terms right. There's some program in there, but like
basically
Denver
they're taxing all development in some way to where it's like you have to either contribute to an affordability fund that's allocated, something like that. Yeah.
And that's part of the reason. That's been another factor, at least in Denver County. Between the interest rates increasing and also that's why we were seeing a huge drop off in construction. I remember there was a rush of a lot of developers. Like once you get to certain, planning stage or your site plan development approved, you're kind of like, oh, cool, we got it in here. We can build any time as long as you're in before that went into effect.
Mm-hmm, sure.
And so there's a huge rush of permits. So between the market conditions of interest rates and expenses, and then that's why we're seeing just a huge, almost no properties or no apartments in the construction pipeline.
Sure.
But look at this chart here. Then we'll move on to some other articles here. So this is July data year to date. So this is kind of showing where the market stood, year to date in July between it. So and I want to do detached versus attached. So the average detached price, I cannot highlight that with my mouse, but the average detached price in 2021 July was $685. 2022 was $785. 23 was $763. So that's where we saw an average small decline. 2024 was $784. So basically back to where we were in 22. And then year to date 2025 has been at $795. Now, of course, we know different sub-markets are facing different things, but overall, we saw a small dip in 23, which was, hey, rates went up, activity slowed down, but prices continue to march on. Look at for the detached down here, and this is closed average.
Or this is attached, right?
I'm sorry, attached. You're right. Thank you. Attached, so condos and townhomes. And I wish we had condo data by itself.
I was thinking that exact thing. It would be so. I think there would be a big difference between the two. And condos are really sucking that number down.
Yeah, because townhomes are doing.
I think
pretty good.
Yeah, they're probably off the pace from single family detached, but I don't think they're nearly the same as condos.
And that but in 2021 it was 408, 22 was 458, 23 was 452, 24 was 459, and then 2025 was 439. So you can see here while detached are up significantly from 2021. And higher than they were in 2024. Attached is up some than 2021, but lower than 2024.
Mm-hmm. So I think even lower than 2022. Yeah.
Oh, you're right. Yeah. I mean, they're lower than basically everything than 2021.
Yeah.
So yeah, I think it's just interesting data on there. Again, we kind of get the condos out there, but it kind of continues to tell the story on there.
Look at the transaction volume too. How much it's fallen on attached. Went from 10,400 in 2021, then down 9,000, 6,000, 6,000, all the way down to 5,800. So just volume has decreased drastically in that 5-year period.
Yeah. And I mean, you're seeing that still on the lending side, right?
For sure.
Have you closed on any condos on the buy side this year as a lender?
I think you asked me recently too, and no.
Yeah,
nothing.
Yeah, so still nothing.
Exactly.
Right?
Yeah, and you're always looking at it, it's like, geez, is it a townhome or is it a condo? When it's a townhome, it's like, phew, that's no different really than a single family detached.
Have you closed on townhomes this year?
Townhomes, yeah.
Yeah, so townhomes yes, detached, yes. Condos,
zero.
No.
Yeah.
And multifamily, 2 to 4 inch, you've closed on a bunch of those too.
Yeah.
Yeah.
Yeah, especially with our house hackers have been doing a lot of the multi stuff.
But kind of going back to, I think you mentioned earlier, Brandon, about the starter homes, and I think that is why we're seeing one of the the natural market dynamics. That's why some of the best investment plays right now are doing the room by rooms for pure affordability, right? Where people go buy a house add 3, 4, 5 bedrooms, sometimes add, sometimes a couple bathrooms as well. But then that's where a lot of people are renting, and that's where, based on the market, that's where all investors are seeing the best returns. The best rental cash flow I'm seeing right now is in room by room rentals. Yeah. We've talked about all the time with the house hacking stuff we do, especially with what Jeff and Miller do. They'll go add a few bedrooms. They're
seems to be picking
their
up
cash
some
flow
steam.
a couple $1,000 a month sometimes.
Yeah. We've had some clients definitely taking advantage of that.
Yeah, we've had a bunch of clients this year do it.
Yeah, that and the multi seem to be the big play for house hackers for sure.
Yeah. Do you ever get requests at Key Renter PM for room by room rentals?
A little bit, yeah.
I
think it's pretty well known in that area that, like in that subsector of investing, that there's not really traditional property management solutions for it. Now, some have emerged, but they're real small operations, and you've got pad split that'll take some of it and that kind of thing. But yeah, I think that it's pretty well known that like there's no property management like comprehensive solution if you're going to go room by room.
Yeah. All right, let's talk about rent and vacancy. So, Brandon, we were talking about this article earlier. This was the AAMD, the Apartment Association of Metro Denver. And I may have screwed that initials up, but what's happening with vacancy and rents at the apartment level? And I know you got some additional data to talk about.
Yeah, so just like in real estate sales, we see some seasonal trends there. So this article was wrapping up. They had finalized their Q2 data, so they were comparing that. So what we're seeing is things are up from Q1, so up like $13 in rent, vacancy down from like 7 to 6.4 or something like that, Q1 to Q2. But year over year, still a pretty significant decrease there. So like our vacancy for Q2 2024 was 5.6, now it's at 6.4. The increase the dollar amount increased Q1 to Q2 in 2024 was $71. That same quarter one to quarter two was $13. So a little bit of an uptick. It could be worse, but yeah, we expect some seasonal recovery there and didn't, and saw a little bit.
What do you see in your portfolio, kind of like the rents and overall, and breaking out the different asset classes?
Yeah, I think it tells a similar story as what we've been saying. Some of those condos can be tough. The desirable single family seems to hold pretty strong. There have been some suburban kind of markets where single family has been surprisingly soft. So yeah, just certain parts of town that.
Like what parts do you know off the top of your head?
I don't. Yeah, I'll have to dig into that a little more for next time. But yeah, just places where there's nothing exciting going on. It's not like some headline as to why it'd be softer, but it's just a little bit more inventory and
something
houses
outside of like a Sloan's Lake, right? Sloan's Lake would be desirable.
Yeah,
there's a lake,
for
there's
sure.
a park, there's stuff. And
one of the things like you're kind of like maybe 1960s, 1970s home in like Thornton, North Glen. Think of that where it's like often those are like 5-bed, 2-bath. We've seen some of those. It's like no sprinkler system, kind of minimal amenities. They don't look great, but those have been a real struggle. So kind of that traditionally, I think of those as like the roommate rental. You might get, or it might be a multi-generational family. And sometimes you could really push rents on that kind of stuff because you get people who just in that market, it's like it's the only thing that's real affordable. When you're dividing the rent up that many ways. But we've seen those be much softer than in past years. Just hard to rent that kind of, and it's B-class stuff. It doesn't present super well. It's got, it's a rough neighborhood. You might have some neighbors where you can't do anything about that house is, full of like 6-foot weeds and that kind of thing. So it just kind of, I think in any market where it's a little bit softer, like the best properties seem to do okay, and then the worst properties take the brunt of it. So
they kind of do.
If the whole market moves 10%, it's not like everybody moves 10%. It's like the top do fine, and then the bottom drop 20% or something. So that's kind of the dynamic we've felt.
Do you guys do much in kind of the micro markets of like college campus rentals?
Not a ton of that.
I'm always kind of curious on how those are doing, like your DU area, your CU.
Yeah,
Fort Collins.
We have some
CSU.
properties that sometimes will hit that, but it's when you're really all in on that, it's like you have one lease up day a year, and you start marketing it well in advance. And
just doing the school cycles.
We haven't gone that deep. We haven't had a concentration around like an area like that to go that far.
Right. I wonder what they're doing though.
Yeah.
Market wise, they probably do pretty well. Are pretty stable and steady. I would imagine.
I would think. Yeah.
Yeah.
So another comment in here about construction pipeline and absorption. So the Denver market added about 2,400 new units in Q2. Net absorption remained strong at about 4,500 being absorbed. Now,
if we keep seeing that, we'll be great, right? Let's add 2,500 apartments a quarter and absorb 4,000, and we'll be we'll be in great shape here in 4 to 6 quarters.
Right. Yeah, well, exactly.
Goes on to say, so the previous 12 months, about 15,800 units came online, with about 11,000 being absorbed.
Yeah, so that was where we're feeling it. There was a huge shortfall, rolling 12 of absorption.
And then 2024 is the estimated peak, about 23,000 units coming online, with 2025 estimating about 15,000. Of course, we'll know at the end of the year, and a lot of construction projects are taking longer, of just delays, increased fees on there as well.
There was one line in there that used to be your average timeline was, I think they said 24 months. Like that's what everybody counted on for delivering an apartment, and now it's 30 to 34 months.
Yeah.
Really?
Oh yeah, that's just the. I've never had anyone who's working with Denver on permits have any
positive
nice things
Although
to say.
We should say Johnston passed the thing that was one of his initiatives. This like we're gonna fast track stuff, so it's like 180 days we'll have an answer for you, or you get a refund up to $10,000 for your costs in this.
I know for big apartment developers, they're like that was a joke.
Okay.
I see my friends are like, well, that doesn't really apply to us
because we're 250,000 and
I mean, one of them was like, our carrying cost is $2,000 a day. Like,
holy,
every day matters. Like we don't care about that. Like just get it done.
So maybe it's a little gesture, but I guess at least it says they're hearing.
Well, hopefully they're moving in the right direction, right? I know they've made some changes. Like some saying it's never going to turn on a dime, but I think it is coming.
Because there is something to the. I know it doesn't like offset the real holding cost for a big project, but it's real money to the city if they got to start paying these things out because they're not getting timelines hit. Like it's meaningful to them.
And I mean, they're in like a couple of weeks they have to do a bunch of layoffs. Like they have a budget shortfall, so
and they have to balance their budget too.
Yeah. So here's another thing we talk about. So Denver no longer will require parking minimums for new developments. I like this quote from one of the councilmen on there. We have a housing crisis, not a parking crisis, is what he said.
I might argue there is also a parking crisis, having just gone to Savannah Bananas on Saturday.
Oh, I bet you.
Oh, it was a mess down there, and there were lots at $80 or something like that. But that's acute, right?
Yeah.
We don't have a sellout event that often.
No, but that goes to, they said, their idea there is, and I mean, because I thought that was interesting because, parking is a pain in the butt. Like, their response saying more the free market developers will come up with more creative ways or be able to, better forecast demand for their parking spaces on there. But I'm curious if that helps to go out there and actually move the needle on anything.
It was interesting because this has gone, full circle where, there's that building, I think it's called the Brooks Towers on, 16th or something, that I think developed in maybe the 70s or something, or maybe the 80s, and there's way not enough parking for it. There's not even one spot per unit in there, and there's 3-bedroom units as much as that, and it was always such a challenge, and it led to over the past 15-20 years it was really hard to sell stuff there, especially if it didn't come with parking and that kind of thing. But maybe we've just finally caught up to the public transit and this. I even have wealthy friends who share a car between, them and their spouse. So maybe it's becoming more common.
And everybody's riding their electric scooters.
Yeah.
Those things are everywhere. Electric bikes.
Yeah.
Scooters.
It's made it easier to get around.
And it's obviously very compact, right? You throw it in your room.
You can crank a lot of those in a little part of the sidewalk.
3-bedroom, you can use one as your garage.
So here's an interesting article. It was titled 10 Denver Projects Picked to Get $100 million in Downtown Development Authority Let me share the screen on here. So the reason this stuck out to me was because they have a couple office to residential conversions. So the backstory: on Wednesday morning, and this was 2 or 3 weeks ago, Denver Mayor Mike Johnston detailed 10 projects the DDA boards unanimously approved to get a combined $100 million in funding. The Denver City Council still needs to sign off on them. So the 2 projects stuck out to me was $17 million to help finance an office to residential conversion at the historic Symes building. It will create 116 units, and then $14 million for another building that would create 120 residential units. So we're seeing more of those office conversions on there. But so $17 million or 116 units by $17 million, that still seems like a pretty steep price, right? I mean, what are your guys' thoughts on those numbers on there? Like, to go out there and convert it to residential.
So if it was 100 units, that would be 170,000 a unit to convert it. Am I doing the math?
Yeah, that's what I was just doing on here. So 116 units. Oops, if I can do it right. Doing math while someone's watching me is always challenging, you know.
Right.
So that's about $146,000 just for the money they're getting there to convert. I don't know what the overall construction costs are on there. Like, that's just, you know, the DDA money on there, but $146,000 a door for the first one. And
well, that's what they're getting subsidized, right?
Yeah,
so they got
that's a subsidy, and that's still whatever else is. I'm assuming it costs more to convert, probably.
Yeah. Unless maybe that covers all the construction and some of the holding costs, and I don't know, taxes during that time.
I would love to see the deals on there, because I mean, like, what's kind of interesting on here is, I mean, there are apartment buildings trading below $145,000 a door right now. You can go out there and buy. So I think and the reason I brought that up is it's interesting to see that trend, but also highlights just how expensive it is to go out there and still convert office to residential. Like, I'm all for it, but just like the numbers, like, I have a hard time making the numbers wrap around. Like, I mean, I've seen deals in Denver where you can go out there and buy a building at 110 or 120 a door, and then we're doing a conversion at minimum $150,000 a door. I
mean, both of these are historic buildings, so that may have something to do with both increase in cost.
Yes.
To maintain the historic thing. And like, what's the alternative? It sits there and it's ugly and it's not rented, and that causes problems too. So like, there is some incentive to get people living here and spending money downtown and that kind of thing.
Yeah, I mean, historic buildings, those are a can of worms and all that. But I also make the case like, hey, if the goals really go out there and increase affordability, if you got $30 million to spend on there, you can probably allocate that better to go out there and create more affordable housing.
Sure.
Yeah. So what math? I thought you were doing.
Oh, I was looking up the buildings.
Yeah.
Just because I wanted to recall what they look like.
Yeah. The other interesting thing on here is out of that, the biggest expense or item out of that is $30 million is going to the Civic Center Park for new infrastructure, lighting, and garden walkways and tree canopy, which, I don't know. Seems like that could be spent. I don't know. I don't have much opinion. I don't know, but I'm just, my guy's like, well,
kind of hits you a little odd.
Yeah.
Yeah. Okay.
I think we got bigger problems than the park down there. But I'm not a Denver resident, right? I'm down in Douglas County. So another article we had talked about, Broncos. This was interesting. So I know, Brandon, we've talked about this in the past. You saw the same article. Why pull this up? Tell us about what's going on there.
Yeah, we touched on it last time, but to be honest, I'd never heard of anyone talk about the Burnham Yards until this whole thing. But yeah, there was, I think last time we talked about, there was someone kind of did some digging from the Business Den and found that there were all these LLCs buying up land around, basically it's a little bit east and south of the current stadium.
Here's, I got a Google map they provided on here. Yeah, so keep talking.
Yeah, so like the Buckhorn Exchange area, if you all know that.
Mm-hmm.
But yeah, there was some deals changing hands, and this has continued to happen. And now I think the Broncos know that it's like cat's out of the bag that they're behind this, so it wasn't as secretive this go around. But they're continuing to buy buildings around that area, and
yeah, I mean, they just bought.
Must have a plan for something big.
This one is on August 4th. Sold a warehouse for $10 million, which is twice what they paid 5 years ago at $5 million. So going to another LLC that was formed a couple of years ago. And I remember reading another article on here, and I think it was, Lone Tree. I forget another area where they mentioned, hey, Broncos may go. And the city was like, yeah, we've never talked to Broncos about doing anything down there. And then what they purchased $150 or $2 million worth of properties out here.
Yeah.
I'm really curious to see if they build something there. And then Empower Stadium's only 2 miles up the highway from them.
Yeah, what are they
even
doing
that far? Yeah, it's
maybe they'll turn that into affordable housing up there. No. What would be what would there be the reason they'd really want this new stadium? Is it just because they could better develop around it for all the other revenue generation that can go along with a stadium, and they get to own that?
I have no idea.
I was going to say, your guess is as good as mine.
These aren't the types of people we're playing golf with on the weekends.
No, a lot
or whatever,
smarter people than us combined, probably.
I'm sure when I go there, my beers will be cheaper, though, right?
Yeah.
When I go to the stadium. Hey, another thing we talked about here as we wrap this podcast up. You talked about in Rhino this article about what's going on with Zeppelin Station, Brandon.
Yeah, I mean, this one just hits because the Zeppelin stuff in Rhino is so the coolest stuff over the past 10, 15 years, and a lot of interesting things. They've done the food halls and hotels and all this. And this Zeppelin Station has, I think while the other stuff's done okay, they've maybe sold off some of it, but this in particular has been in receivership now for some time. It was, at one point it was full of food vendors and kind of a fun spot, and then it just kind of has deteriorated. Then they put it in receivership, but they had this deal. I remember this article from, I don't know, what was a year ago, when they had this plan to do this dinosaur theme there, and it sounded kind of cool, but that was all part of this clever girl who was going to become a tenant or something, but now they're in default. And from what I understood, it was a little hard for me to follow exactly who was who with all of this, but I think the receiver who was in charge of it kind of wants out, because it's now it's going to be much harder to sell without this tenant involved who is in default or maybe has no plans of moving forward with their project now. And so just a bad situation. And
it's sad, but
you want to see something. It's right there on the river, kind of a cool building, so it'd be fun to see something happen there, but doesn't look like anytime real soon it's going to turn around.
No, in this article,
but no dinosaurs were ever installed.
Yes, that was that new opera that's supposed to come in. I think then he had an investor where he couldn't get the $1 million from investor to fund it, and just one of those things where capital was just coming by. But they were saying, this was saying at 1 p.m. on a Monday, and this was end of July, just 2 food stalls operated in the space designated for a dozen, and only 8 people were there, not counting workers. Now, I haven't been there probably since maybe pre-COVID, or I can't remember. And back then, it was just it was packed. I remember every stall being there, and it was. There were 100, if not more, people in there just having coffee, working, having lunch, whatever it was. It's
interesting because there's other food halls like Avanti that's still bustling and full all the time, and that. So some have done really well and some have not.
Yeah. All right. Last thing here as we round out this month's podcast. Troy, interest rate news. Interest rates have softened a little bit.
We're kind of Fannie Mae, Freddie Mac average is right around those mid 6s, so we kind of like that. That's helpful. We've been talking about in the past, not so long ago, we were touching high 6s, low 7s. And then just had an FHA. FHAs are always a bit better than Fannie and Freddie, but lock in at 5.5. So paying some points to buy that down, but we're seeing that, and it can happen.
You just closed on that in July?
The 5.5 just locked this morning.
Oh, wow. Okay.
Yeah, we did with a few points. So their contract closing later this month, early next month.
Are you personally optimistic rates are moving down?
Yeah. There's definitely watching some of the people I follow and look into for the industry insights, and talking about the different Fed nominees that are being talked about out there are probably going to be a little more friendly to rate cuts.
This is assuming that nothing changes until Powell's term is up.
Yeah.
What is that, middle of next year?
Well, yeah, assuming nothing significant happens that could wreck that, of course. But interest rates like bad news and bad markets and all that. So
and the jobs numbers got revised down pretty dramatically.
Yes, so
the other
jobs you think would help. I mean, they're a little bit between a rock and a hard place. They don't want things to get too wacky, inflation go out of hand. It looks like inflation's pretty well in check, but the jobs is the thing. So
I think they feel a little spooked by the whole tariff thing, and if that'll
but that seems to not have had the impact. Everything I've seen, I don't think you guys have seen anything too crazy, have you?
I mean, not yet. I mean, I don't.
Yeah.
I'm not an expert on that.
Could take a little bit to trickle through.
Well,
I think was their fear is like maybe it hasn't shown. Maybe we got to wait and see before we start lowering.
And that's the whole thing right there. There's a lot of wait and seeing going on, and I think that's the same with job markets. I think that's a lot to do with some of the buyers out there, and with these rates, wait and see. So once we get a little more time under our belt, that could open up some doors.
Yeah, but I mean, from a standpoint of if the job numbers are looking worse. Mm-hmm. I mean, that's forecasting that usually recession indicator or softness indicator, rates should drop.
Hey, we need to throttle out of these higher rates.
I saw some article, or I like looking at the poly markets where it's like the group betting markets.
Oh yeah,
and I forget the percent, but they had they bumped up their it's definitely majority thinking, hey, in September they will
do a cut.
Fed will cut rates.
Yeah, I'm thinking that's the case.
Well, and that we shall see.
And then that starts getting baked in the cake.
Like a quarter, or like the 3 1/4s that Trump's
open
for
down
to 1.
A half would be pretty major.
I'll make a bold prediction. It will not be 3-point cut on September. That was what my
I think you're pretty safe with that. Yeah, you're pretty safe with that.
On that for me.
Yeah, no one's going to bet you on that one.
And the last thing, article, I was just getting my notes here. I think it was last month we talked about, I kind of shared some of that home builder, news and the stress they're having. So I know it seems like at least they got 2 properties under contract. So that was, hey, they went from a couple months with nothing to getting some under contract. So it's interesting to see that activity pick up. Now, again, that's a very small sample size.
Didn't they have like 50 listings or 40 listings?
Oh, it was like 100 plus. It was significant. Now I know they're leasing a lot, to kind of like pivot towards leasing because they can't sell right now. Just to cover the debt service and wait a year or two till the market turns and sells it. But I know one of the problems like leasing a new build is they take a lot of money, right? You got to put washer and dryer in there. You got to add some window coverings, things like that, and lease up fees on there.
Yeah. Well, and you got to be careful of the HOAs too, because all those new builds have restrictive HOAs on what you can do for renting.
Yeah,
in there.
Well, these are mostly townhome style, isn't that?
Yeah,
what
these
this
are townhome
developer
styles, and I think they own all of them still too, so they can kind of at least they can dictate what they want to do or amend things. I would think. But again, I'm still a fan if you're out there looking for properties, especially like. I've had some clients, they want more like just, hey, they're busy professionals, more turnkey assets. Mm-hmm. Go out and look at new build properties. Yeah. I'm sure, Brandon, you would like to probably lease those more than the 1970s Thornton properties. Right, they lease better, so there's opportunity out there. Again, always going to come back to where the opportunity is. There's opportunity out there and really good opportunities new builds, like a 20% type discount. Great opportunities out there to go out there and buy a house, add a few bedrooms, do room-by-room rentals for that. Mm-hmm. There's some opportunity in the condo market. We haven't figured that one out yet, but there's opportunities out there. There's, I think, great opportunities out there in like the 2 to 4 unit multifamily. Mm-hmm. I mean, especially that lending program 2 to 3 years ago opened up a lot of that 5% down payment.
Fannie opened up a 5% down.
And we're seeing a lot of people go out there, buy a property, do some light value added. I mean, they're cash flowing. Yeah. I mean, they're cash flowing 6 months while they're living there. And then sometimes they move out, they're cash flowing really well. For the bigger stuff, there's opportunities too, and like the bigger apartment buildings as well. Like I was talking to a broker, and I think it was like Cheeseman Park or that area, and essentially, I forget what he said, but a 10 unit was essentially trading for about 40 to 50% less than it traded like 7 years ago for.
Oh, wow.
So we're talking like a huge price reduction in,
buy them at a discount.
Yeah. So I mean, there's opportunities out there. And so end on the, hey, we're talking about, challenging times, pessimistic news, but that is where that also creates opportunities. Yeah. So go out there, look for them. Yeah. We're going the second half of this year where the market does slow down, especially we're getting into fall and then winter. There'll be some really good opportunities right now, so look for that. Go out there, be aggressive on your offers. And when you buy a property, be very conservative in the rents you'll get, right, Brandon? So put away extra money for, hey, get rents a little bit than you expect. Maybe put away a little bit more for, expenses and operating costs and things like that. But there are some really good opportunities out there materializing in the market right now.
For sure.
Absolutely.
You guys got any closing thoughts or comments?
I think it's all great stuff.
Yeah.
I'm seeing some still good activity. I feel kind of to the point. And Jeff and I have talked about this a few times. We feel like there's some pent up demand. We feel like there's going to be some good traction this Q3, Q4.
Yeah.
Just to your point, Chris, you're talking about.
But I think once mortgage rates is kind of like still once mortgage rates drop below 6, that's where is that kind of like right now the thought of the magic number where that's going to kind of bring just like a wave of buyers back to the market?
Yeah. I don't think it's going to be a mad gold rush, but it'll definitely
it'll be significant.
Yeah. I think it'll be worthwhile, measurable.
Cool. All right. Well, gentlemen, another great podcast. So, of course, if you guys want to go out there and help with property management, chat with Brandon and his team at Key Renter PM. I referred your clients over the last months, and they're all thrilled with your service. Awesome. And we're actually doing a cool webinar here soon, maybe next month or later this month. We're going to do a detailed rent comping because I know that's where we're trying to get as many tools out there for people to know. And Brandon's going to have one of his team members go out there and kind of show how they rent comp. And also, we're going to walk a property soon about doing a turn right now. It's just a current property turning between tenants. And hopefully we're going to walk one that's pre-updated to see, hey, what it's like. Have Brandon's team go out there and talk about, hey, what can you or can't you, hold for the security deposit, and how they go out there and do that, and also navigate some of these new laws that are implementing, I think in August this year. And of course, you can help with your lending needs. Always go out there, talk to Troy Howell at Nova Home Loans. He has done right by probably close to 100 clients for us now. If not, and
not
more deals on that as well. But obviously great professionals around here in the Denver market, and they know the investing game. So thank you guys.
Thank you, Chris.
All right, everyone. We will see you next month for the August monthly update. Bye, everyone.